The ruble rebounded on Friday on speculation that the currency crisis would lead to urgent action by the country's central bank. Having fallen to fresh lows against the dollar and euro as traders dumped the ruble, it bounced back to trade 2% up. The ruble's fall has piled more pressure onto Russia's ailing economy, prompting talk that the central bank will have to prop up the currency. Analysts said the sell-off was panic, and that the bank would buy up rubles. On Wednesday, the Russian central bank decided to limit its intervention in the financial markets. But a one-off intervention was now likely, along with a rise in interest rates from the current 9.5%, analysts said. The ruble has lost more than a quarter of its value since the start of 2014. Western sanctions over the conflict in Ukraine have played a major part in the currency's decline, by making Russia an unattractive place to keep funds. The fall in the oil price is also important, as the export of crude is a major source of foreign currency for Russia. The central bank has been using its own reserves in an attempt to contain the ruble's fall, but on Wednesday announced limits the amount of intervention, which sparked a sell-off. This is full-blown panic, with signs of a self-fulfilling currency crisis, Dmitry Polvoy, chief Russia economist at ING Bank in Moscow, said in a note. At such times, the central bank should intervene. After all, if this isn't a risk to financial stability, then what is? Maxim Korovin, a forex analyst at VTB Capital, in Moscow, said the ruble's depreciation clearly poses certain risks for financial stability. Economists are awaiting a response from Moscow. Capital Economics said in a report that it expected the central bank to act rather more quickly than policymakers initially hoped. The firm said interest rates may need to rise to as much as 12% to make it more attractive to investors to hold the currency. Analysis: Andrew Walker, economics correspondent, BBC World Service. Russia has a catalogue of economic problems, and the downward trend of the ruble makes them even harder to fix. Inflation is too high, now more than 8%. A falling currency drives up import prices and so aggravates that problem. The usual policy tool for dealing with inflation is raising interest rates, which can work partly through the impact on the currency. Higher rates make the country more attractive to invest in. But official interest rates in Russia are already high, and the economy is struggling. The IMF recently described the outlook as bleak. Further interest rate increases may come as the bank tries to deal with inflation, capital flight and the weakness of the currency, but normally the dismal growth outlook would call for exactly the opposite response.